Okay, so you have some credit card debt and you're wondering if you should use a personal loan to pay it off or not. There are a couple of reasons why you would and why you wouldn't want to do that. Hi, I'm Stephen Cruz, mortgage broker with Paragon Mortgages and mymortgagebroker.com, and I provide tips, programs, options, and strategies for Canadians to take advantage of mortgage financing and financing in general. So let's talk about that question. Should you be using a personal loan to pay off credit card debt? And that really is called a debt consolidation loan, and lots of people will apply for them here and there. And there's a couple of advantages of taking out a personal debt consolidation loan. First of all, the interest rate is typically lower, so that's the first advantage. You're going to roll all of your debt into one lump sum, and therefore the payments, there's going to be one payment instead of paying all sorts of different credit cards. And you're going to have a set period of time to pay it off. And normally it's 3 to 5 years that you're going to structure this to pay off the debt in full. There are some disadvantages, though. There's 3 disadvantages. Sometimes your credit cards offer lower interest rates than a personal loan. So it might be worthwhile, actually, to get a credit card instead of a personal loan. And we'll talk about a little bit about that later. Another disadvantage is that if you haven't changed your spending habits, then you might have this new debt consolidation loan and you're going to rack up your credit cards again. And that's really a bad plan. And over my career, I've had many clients come to me, take out a debt consolidation loan, and a year later, they've got all their credit card debt racked up again, and they have to do another one. And if you haven't changed your habits, then you're not putting yourself in a better position. And I always believe that you should be putting yourself in a better position if you're taking out any kind of financing, whether it be mortgage financing or credit consolidation loan or whatever. I created a video called Budgeting Sucks, Stop Living Paycheck to Paycheck. And I'll put the link up here, and I'll also put the link down in the description. And if you watch that video, it talks a little bit about strategies and how you can change some of your habits to be more effective with your cash flow. And I've improved people's cash flow by substantial amounts when they go through that little program. There's 2 ways to pay off your debt faster. First way is called a Snowball Method, and that's where you pay the lowest interest payments first. And the second method is called the Avalanche Method, and the Avalanche Method is when you pay the lowest interest rate first. So Snowball, lowest payments first, Avalanche, lowest interest rate first. And I have another video, and I'll put the link here as well, and that talks a little bit about those 2 strategies, and it compares 2 examples, and you can see how people can pay off their debt faster by utilizing this method. Really, in my opinion, you want to utilize that method in conjunction with the budgeting strategy that I talk about. Even as much as budgeting sucks, and I really don't believe in budgeting per se, it is important to have an understanding and really know what your cash flow is. And so I'll put that description down below as well, and you can take a look at that. What I've noticed, when people don't change their habits, then taking out a personal loan and doing a consolidation loan or whatever isn't necessarily the best way to go. And so you're going to rack it up, and you potentially rack up your credit cards again and just be in a worse position than before. One thing I did mention earlier is some credit card companies will offer lower interest rates, especially introductory rates. So companies like MBNA and Capital One, and same as RBC Visa and TD Visa and a whole bunch of different cards at different times will offer low introductory rates. So once you've set up your cash flow, and once you know and you've got a handle on your spending, so you know what you're doing, then you could instead take advantage of one of these low introductory rates. And they can be as low as 0.9% for the first 6 months or a year, 1.9. Throughout the year, they have different options and different rates available. What they want to try and do is encourage you to start using their credit card and not using the other one. But you can utilize that low interest rate to pay off your debt that's at a higher interest rate, and then really attack it and pay it off faster, and using a bunch of different things. So use either the Avalanche Method or the Snowball Method, and I can send you a spreadsheet, an Excel spreadsheet that you can put all your debt in and figure it out. And I'm happy to do that. Just connect with me on my website and ask for the Snowball Method or the Avalanche Method, and I will send that to you, no charge. and really important to have a plan. So whether you're taking out a loan to consolidate debt or just taking out a loan in general, you want to have a plan and make sure your cash flow make sure you can afford it with your cash flow. That's really important. It's a bad plan to take out debt and not know if your cash flow can afford to pay it. If you like the information, please smash the like button. That really helps me out. Subscribe if you want more details about financing for homeowners, home buyers. I provide all sorts of information to help you get the best deal and understand the programs available. Many people don't understand the programs available, and your bank, if they don't offer the program, won't tell you. And I have access to all the different banks, so I know what all the different programs are, and some banks' programs are better than others. So it's important for you to know so that you can make the best choices for you. So let's again summarize. Should you be using your personal loan to pay off credit card debt? No, it does. It depends. And it depends on whether or not you can get a better deal somewhere else. Sometimes taking out a personal loan is the way to go, but sometimes sending a credit card or whatever is better. I do have a company that I've used to set up personal loans, and I'll put the link in the description below, and they will often get you the better deal. I've had clients go to their bank, and the interest rate they charge isn't always the best, whereas this online company, they will search the market for you to find the best personal loan for you, and you can follow that link to see if that's possible. But I would first look at introductory rates. Depends on how much money you need to borrow, and also look at your cash flow. So create a plan. So those are the most important things. Create a plan, and then look at potentially lower rates, maybe switching from one credit card to another, and then third, doing a consolidation loan potentially, and then looking at the avalanche or the snowball method to pay it all off. Thank you for listening, and have a great day.